how'd you come up with the Bollinger Bands?
So I was an option trader in the early 80s. Option premiums running very high. It was pretty easy to make a living trading options in those days. But the key to option trading is the same as it's always been, and that's a good estimate of volatility. I was lucky I had an early microcomputer. This was in the days before PCs, but I had a spreadsheet called SuperCalc, and I would use it to calculate the volatilities for option trading. And one day I copied the formula for volatility down a column of data, and I saw that it was changing over time. That doesn't sound special today because we know that volatility is volatile. But back in those days, we thought that volatility was like a property, like the house is white or the car is blue, and that it didn't change over time. So I had been using fixed width trading bands. We called them percentage trading bands.
Sure.
And I was looking for a way to automate setting them because it was a very labor intensive process to set the width of the bands, pencil, paper, overlays, and stuff like that back in those days.
Yeah.
And the problem really is that you let your emotions into the trading process when you did that, because if you were bullish, you set the bands to present a bullish picture. If you're bearish, you set the bands to present a bearish picture. So I wanted to automate them. And I saw that volatility was changing over time. And I said, ooh, I bet I can use that to set the width of bands.
Oh, interesting. So when you started seeing like the bands tighten, were you just kind of starting to play around with it and you started seeing the bands tighten, volatility decreasing, all of a sudden you saw a pretty strong move one way or the other? Is that
so
how
actually that wasn't the start for me. That was the second stage for me. The first stage for me was just to if the price of a stock was high enough to get to the upper band, I would then compare the action of a couple of indicators, volume indicators and such like that, and see if they confirmed. And if they didn't, then I would take that as a non-confirmation. And the same on the downside. If weakness got down there, if the indicators confirm the weakness, then you just assume that you're going to go further.
Yeah.
But it was like that for me in the beginning. It was only later, a couple of years later, when I really started to focus on the dynamic changing quality of the bands and talk about things like the squeeze when the bands are very tight together, or the bulge when the bands are very, very, very far apart.
Well, it might be a good idea for us to bring some visuals up at this point. And so for people listening in, as we get to this visual component, you might just look back on this at your leisure and go to investors.com/podcast or onto the YouTube channel where you can see the visuals. But let's go ahead and start. Again, you kind of said that the Bollinger Bands are helping you define kind of a high and low on a relative basis. So what do you mean by that, on a relative basis?
So by definition, prices are high when they are at the upper Bollinger Band. And by definition, prices are relatively low when they are at the lower Bollinger Band. That's sort of the key to all trading bands, not just Bollinger Bands. There are many other flavors of trading bands out there that are used by traders. But that's sort of the generic idea behind all trading bands. You then use that information to compare price action to the action of indicators or to do pattern recognition, things like that. So they give you a frame of reference. That's that on a relative basis. They give you a relative frame of reference to frame price action and make decisions, rigorous decisions, I might add.
And just real quickly, again, this is something that a lot of us might take for granted because it really does seem kind of simple when you think about it. You pick a time period and do standard deviations. But what time period? Why did you decide on a time period of 20?
So that was the time period we were using at the time. At the time, the most popular market timing system was a very simple system using the Dow Jones Industrial Average and a 21-day moving average and bands that were spread 4.5% above it and 4.5% below it. That was just I don't know who came up with that, but it had been around for some years, and it was a very accurate market timing system. We would compare price within those bands to the action of two indicators, one based on up and down volume, and the other based on advances and declines.
Mhm.
And if you get to the upper band and one of those indicators was negative, that would be a sell alert. If you get to the lower band, one of those indicators was positive, that would be a buy alert. So I just adopted the 21. I don't know. I changed it to 20. I changed to 20 at some point. I couldn't really tell you why, but there it is.
Yeah, just to make it even. And then you're just taking a standard deviation, right? Or two standard deviations, I should say,
Yeah.
above and below. Just that easy,
Yeah, the
right?
volatility calculation is simply the population standard deviation calculation. And the upper band is 2 times the standard deviation above the middle band, which is the 20-day moving average. And the lower band is 2 times the standard deviation below the same middle band, that 20-period moving average.
And of course, for those stats geeks, that kind of tells you that most of the action is going to be in between those bands. But as you said, it's really about where you're at within the band. So here's the DIA, which is the Dow Jones Industrial Average. And what is it that you're looking at here, and how do you use these bands? And just so people know and orient themselves, the blue line here is your 20-day moving average line. The upper red band is your 2 standard deviations above, and your green line is your 2 standard deviations below.
Correct. And then in the clip immediately below price, that sort of jagged line there, that's percent B. We'll get to that in a couple of minutes. And in the clip beneath that, that's bandwidth, which tells you how wide the bands are. So percent B tells us where we are in relation to the bands. So, I've highlighted 3 setups here. The one on the left there is a squeeze. Excuse me. The one on the left there is a squeeze. That's where bandwidth is very tight, and it's a forecast for increased volatility. And you can see that a fairly meaningful decline comes out of that squeeze. Then over on the right-hand side of the screen, there's another circle, and that's another squeeze. If you look down to the bottom there's a little orange arrow pointing to the trough in bandwidth, and that's how we identify when there's a squeeze or a bulge. And
so John, when you're starting to get that squeeze, when that volatility is really starting to contract, is there kind of a probabilities that the trend's going to continue? Like for that second one, did it give you a little bit of indication that maybe it's going to break one way or the other, or you just wait for the break and then you go with that trend?
I mostly wait for the break. Sometimes you can tell from the trading dynamics going into it that there's weakness building up. Very often we'll use volume indicators like intraday intensity. That's one of the components of the O'Neill accumulation distribution ranking. So sometimes we use an indicator like that. And if it's tailing off, if it's showing weakness, then we'll look for a decline. In this case, you got a little bounce to the upper band and then a downturn. That we call that a head fake, and that's actually my favorite trade in relation to the squeeze.
And so, what is it that you're using as kind of your signal? Again, just to be clear, is it that break below the band? Once you have the
it's a big reversal of price to the downside. And if you, I know it's a little hard to see on this screen, but you can, you'll be able to go home and look at this on the big screens that you all have. You can see that there's a nice price reversal in there to the downside, and that would be my signal.
Okay, very good. The next chart. Oh, one more area here to go over.
So that's a classic W bottom. It's a new low in price that's not a new low in relation to the Bollinger Bands. And for that, the signal is the reversal to the upside. And you can see that, you can see the orange line there. I'm great. I'm pointing toward the screen. I'm sure.
I'm hopefully pointing for you. You let me know if I'm in the right spot with my red arrow.
So, you can see that we make a new low in terms of price, but it's not a new low in relation to the Bollinger Bands. You can see that from percent B, which is at a higher value on the second low. So we just wait for a reversal to the upside, and that's our signal. And you can see that leads to a very substantial rally.
Yeah.
Okay, let's go ahead and we already talked about how the defaults for the Bollinger Bands are the 20
but the
period.
bottom line here is really important. People use all different values. Some people use really short bands, 10 periods, and just plus or minus one standard deviation. Some people use really long, exaggerated. Just feel free to adapt all of this to your trading style and to what you do. There's nothing magic about these numbers. These are the numbers that suit me and my trading style and my personality, and I've used for years. But there are tons of people using different values and getting value from this framework.
Yeah, perfect. So some of the indicators, you've mentioned this percent B. Let's talk a little bit more about that. When you say it's where you're at in relation to the Bollinger Bands,
So it's
kind of
simply
like a stochastic.
That's exactly correct. That's the formula for stochastics, with the Bollinger Bands upper and lower substituted for the periodic high and the periodic low. So that's exactly correct.
Okay.
And I did that on purpose because I wanted bandwidth to read like a technical indicator that technicians would find intuitively easy to use. So it's just the distance from the last price to the lower band divided by the distance from the upper band to the lower band. So it'll be 1 when you're at the upper band, 0 when you're at the lower band, and 0.5 when you're at the middle band.
The midpoint, exactly. Okay, here's another chart on SPY. So what are we looking at here?
So in the smaller circle shows you a little tiny W pattern. We make a new low in price that's not a new low in relation to the Bollinger Bands. You look at that little tiny line, orange line on percent B, and you see the divergence there. And then we come back up and we make a new low in price inside the bigger circle, and you can see the longer term divergence. And this is something that happens time and time and time again. We call it the fractal quality of these patterns. We'll make a little W bottom, and then it'll become part of a larger W bottom. The pattern repeats so many times. Very, very interesting. It's just the sort of thing that adds value. It increases your confidence in the patterns that you're seeing. Often you'll see a little W on the left-hand side of a big W and a little M on the top, the apex of the W, and then another little W on the right-hand side. Just makes it much easier.
And so again, what you're really looking at here is that divergence where the new low is happening, but you're not getting that confirmation of a new low on the percent B. And so you just look for that reversal again, right?
Exactly.
Okay, great.
And we wait for the reversal because when we just have the new low, right, we wait for confirmation. We wait for the market to confirm our opinion, because it's only an opinion until you get the confirmation.
And and on this chart here, where would you consider the confirmation to happen? Is it taking up?
It's the first green bar.
Okay.
Inside the lower band.
Okay. Wow, that's pretty early still. Yeah.
So quite the move from there.
So the nice thing about these trades is that you're risking a very small amount. If you go to a new low, the trade's broken, right? So and the potential is for a trip to the upper band. So you're risking a small amount in chasing a much larger potential, and so the risk reward of these setups is quite attractive.
Like that a lot.
Now you got a nice move here. What we're showing here on SPY, all the way from 410 up to 454. It did touch the upper band here right around 450. Would that have been a sell signal at all, or you just kind of let it ride, or until you kind of get that same non-confirmation?
Exactly. There's nothing about a tag of the upper band that's a sell signal in and of itself. You need something else, some other form of technical deterioration, because prices can and will walk up the upper band, and they can and will walk down the lower band. And that's not a long series of buys or a long series of sells. That's simply a walk down the band or a walk up the band. What we look for is, conditions to deteriorate in a pattern to form that tells us that, it's reversal is ripe.
Yeah, you can almost see it on the left-hand side of if you go back for a second, on the left-hand side of the chart, how it's just walking along the upside of the band and just bouncing off the moving average, which is, it just keeps staying in the upper part.
Mhm.
Yeah. That's the typical signature of a strong advance.
Mhm. Now we've got a chart here with Boeing, and so now we've gone from an index, because you can use this on indexes, individual stocks. So is there anything that you have to change when you're looking at an individual stock, or all of that math is kind of done for you, right?
No, this is where I started. I started trading individual stock options using these tools and such like that, using 20 periods and plus or minus 2 standard deviations.
Mhm.
Here you see on the left-hand side, you see a classic little M-type top that leads to a really meaningful decline. And then, that's followed by a W-type bottom, again, defined by the Bollinger Bands, and which leads to a substantial rally. So you just look for these setups, and you know, that's the nice thing about trading individual stocks. With the market's the market, right? You got one market basically for
Mhm.
Americans, and I suppose that there's variations like, the Dow or the QQQ, something like that. But the market's the market. For stocks, it's a different thing. You just go through until you find, the stock that has the right pattern, the right setup for you, that has the right risk reward characteristics for you, and trade that. And if but you can't, try to force trades on every stock. You just go through and, rifle through the list, and eventually you find a setup that you like and you go with it.
Are you generally using daily time frames, weekly time frames? What's your kind of preference, or all
I'm a,
of the above?
I'm a daily and weekly trader.
Okay.
I use daily Bollinger Bands and weekly Bollinger Bands.
And what is your normal time frame in terms of your holding period that you're looking at, or just as long as the trade is working, or do you have kind of a typical for you?
It could be as long as the trade is working. You'll see when we talk about stocks later on, an example of a holding that I've held for years and years and years. It's just the right stock in the right in the right environment, and doing really well. So I don't find any reason to sell it. So I guess there's a difference between trading and investing. Sometimes you get into something in a trade and you realize that it's going to work out to be a longer term investment. So maybe instead of selling it, you trim it back a little bit and hold on to the remaining position and try, for a home run instead of a single.
Yeah, gotcha. Let's just talk real quickly a little bit more about the bandwidth. Again, this is kind of how wide the Bollinger Bands are what you're looking at here. And so,
Yes. So this is just the distance from the upper band to the lower band. We call it bandwidth, and we divide it by the middle band so that it's a normalized quantity of percent. Again, very simple calculations. We use these to find squeezes and bulges. So we say that a squeeze is where trends are born, and a bulge is where trends go to die. So you see that here. We got a couple of squeezes that lead to big moves, and on the right hand side of the screen you see a bulge that marks the end of that downtrend.
Yeah. Now, what about around earnings? I'm sure that a lot of times the extra volatility with earnings, you get a gap up or a gap down. That's going to potentially really increase that Bollinger Band width.
Yeah.
Do you
Yeah,
handle those differently at all?
The market's reaction to earnings has become ever more problematic over the years. Especially the market's reaction to guidance, which seems ridiculous to me, because at best it's a forecast, and often they're dead wrong.
Right.
So, but the market really is taking guidance to heart, and putting a lot of volatility into the market. It just makes our job harder. That's all it. All it is.
Yeah.
You have to. One of Charlie Munger's favorite sayings was that if you can't stand a real decline, then you shouldn't be investing. I'm not sure that I agree with that in its totality, but I would say that a variation of that is, if you can't stand this sort of volatility that we're seeing in the markets now, and one of these guidance reactions is going to cause you to get out of a stock, then you really ought not to have been in it to start with.
Right. And let's see. Here's another one with Caterpillar on the Bollinger Band width. So what are we looking at here?
So just look at the dead center of the screen. You see a squeeze and a break to
Mhm.
the upside, leading to a nice rally. And then you see a bulge marking the end of that rally. And the reason I put this chart on here is when you see the bandwidth turn down like that, we call that a bulge. And it doesn't necessarily mean that you're going to get an immediate price reversal. It means
Mhm.
that that leg of the move is over, and you could easily get a consolidation or a reversal. You need to look at price and study what's happening. Often, it will be a consolidation, and you go sideways for a week or two to just the move. People, investment stocks, as they say, gotten a little bit ahead of itself, so it needs a pause to refresh, something like that. But sometimes it'll be a reversal. And if you look at the right-hand side of the chart, you can see a squeeze that led to a decline, and the bulge, instead of leading to a consolidation, leads to a reversal. And,
Mhm.
and you head strongly in the other direction. So I wanted to show you both pictures of both sorts of reactions to bulges here.